Hey everyone, in this video I wanted to share with you one dividend stock that's down 43% off its highs that I think you might regret not buying on this dip because it has excellent prospects going forward. So before I reveal what that dividend stock is, I'm going to go through some of its financial metrics, and then towards the end of the video I'll reveal what the dividend stock is. So let's get right into this stock that's down 43% off its high. Of course, if you're investing in a dividend stock, one of the things you're most interested in is the dividend yield. And this stock boasts a dividend yield close to 1%. But what I'm excited about this dividend stock is not the current dividend yield, but the potential for future dividend increases. That's right, the prospects of this company are looking so good that perhaps over the next several years, the dividend payment could increase meaningfully. Now, take a look at this company's revenue growth over the last 3 years, and what you'll notice is that since the pandemic, the company's revenue has soared, and that's a logical conclusion. The pandemic was a good thing for this company. It created supply chain shortages, which ended up being a very good thing for this company because competitors were not producing as much supply as before, and so all of the industry was only producing the supply that was selling at the highest prices, and then nobody was, well, I shouldn't say nobody, but very few companies were offering discounts, promotions, or incentives, which was allowing for these supply to sell at higher profits. So all of that has been working in its favor, and the supply chain shortages are not done. There's still supply chain shortages in the system today, which are expected to last beyond this year, right? Beyond this year. It's not completely back to normal just yet, and that's a good thing for this company going forward as well. And I talked a little bit about how that was allowing the sales to go at higher margins. And you can look here. What I have here is the operating profit margin over the last several years. And what you'll notice is after 2020, during 2020, a big boost in terms of profit margin, operating profit margin for this company. It was below 5%, operating around 3 to 4% operating profit margin, and that's boosted up to 6.65 operating profit margin. And I would not be surprised if it stays higher at this level for the next, I would say, 4 to 12 quarters for this company because of those supply chain shortages that I talked about earlier. And one of the most important reasons why I think you might regret not buying this dividend stock on the dip is because of its relatively cheap valuation. What I have here is the forward price to earnings ratio, and the stock is trading at a forward PE of 5.9, which is relatively cheap. You're not paying too much for this dividend stock. So, what is this dividend stock? The dividend stock is GM, General Motors. That's right, General Motors. And yeah, like I've mentioned earlier, supply chain shortages have hurt manufacturing, and so the supply of cars has been limited. Cars are selling at higher prices, and that's benefiting GM. Additionally, GM has the Cruise segment, the driverless car unit, that provides you as an investor an option on a huge upside that could potentially bring GM billions in profitability if the company progresses towards that target sooner than expected, or even as expected, right? It's just a nice little option embedded in the company that if it works out, it's a big benefit. If it doesn't, it's not a big hit to the company because it's not incorporated into the valuation, I don't believe. So for all those reasons, I think GM stock is one dividend stock that I think you might regret not buying at this valuation. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.